NVIDIA reporting its Q3 results yesterday and shares declining slightly in pre-market trading after taking a bit of a tumble yesterday. What happened with this company's Q3 report? Here's everything you need to know in about 10 minutes. My name is Brian Feroldi. As of the time of this report, I do not own shares of NVIDIA, which is about a $400 billion company. And please note that the company reported its Q3 fiscal year 2023 results yesterday. Okay, let's back up to August and what management expected to happen for fiscal third quarter. Revenue was expected to be about $5.9 billion plus or minus 2%. This would be down substantially because channel partner inventory levels were being reduced. And the company had its next generation products out on the market, and those are going to put near-term pressure on revenue. So what actually happened? Well, revenue came in at $5.931 billion, down 17% year over year. That exceeded Wall Street's estimate and exceeded the midpoint of management's guidance. Earnings per share fell off a cliff on an adjusted basis. These are non-GAAP numbers, falling 50% year over year to 58 cents, badly missing Wall Street's estimate. Management does not give guidance on this number. What's going on here? Well, management noted that the U.S. government announced restrictions on the impact of a few of their products, and when combined with weak demand in China, they saw some softening for demand for their end products. Okay, let's take a look at each category. So data centers was the bright spot of this report, no doubt. $3.83 billion in revenue, up 31% year over year, and even 1% sequentially. So the data center business continues to thrive. Gaming is in a massive bear market right now. Gaming revenue is down 51% year over year to just $1.6 billion, down 23% sequentially. What is going on there? This is an inventory challenge. They were basically selling off inventory, and demand remains weak for this business. This is in part due to new products coming out, but it's possible that the gaming business could be at a cyclical low here, but there's no doubt that gaming was a very, very poor performer this quarter. Moving on to professional visualization, this was also another weak spot, down 65%. This is just $200 million in revenue, so this is more of a rounding error business for the company. This is also an inventory problem for the business. And then automotive, a bright spot, up 86% year ago, but at just $250 million in quarterly revenue. This is yet another rounding error for the business and could not come close to overcoming the weakness in the gaming business. Now, management also previously said that margins for this quarter were expected to be about 62% on a GAAP basis and 65% on a non-GAAP basis, plus or minus 50 basis points. How did that fan out? Terribly. Gross margin here plunged to 56%, nowhere close to the 60-ish% range that management was guiding for. Operating margin plunged, net margin plunged, so very, very weak margins this quarter. Free cash flow was awful, coming in a negative number for the period from $1.2 billion in the year ago period. Net income down, and the balance sheet has weakened substantially from the year ago period. They still have a strong net cash position, but the balance sheet has been significantly weakened year over year. Why was gross margin so weak? Well, the company took a $702 million inventory charge this quarter related to lower data center demand in China. So they took a $702 million hit. That is going to do wonky things to your gross margin to the quarter. In theory, that is a one-time hit, and that margin should normalize moving forward. At the same time, like we've seen with so many tech companies, operating expenses were up 30% due to higher stock-based compensation expenses, salary increase, and higher data center and infrastructure costs. So weak revenue, weak gross margin, higher costs, yeah, that's going to do terrible things to your profits. Looking at the company's income statement for the period, research and development expenses were up 38% year over year. That is a big jump. Now, management did note and tout the fact that they returned almost $4 billion to shareholders during the quarter in share purchases and dividends. And so far, over the last 3 quarters, they've spent $9 billion on capital return programs. $9 billion. Despite all of that spending, the share count is only down about 1.5% year over year. So they've significantly weakened their balance sheet in an effort to reduce their share count by 1.5%, obviously at much higher prices than shares are trading today. While the early signs are that was not likely to be a good use of capital. But if the stock price moves higher in the next couple of years, perhaps that will be okay for shareholders. In other news, NVIDIA has plenty of information to dig through. The ones that stood out to me was that they have a new multi-year collaboration with Microsoft, a new multi-year partnership with Oracle, a new partnership with Nuance, and they have tons of new products coming out, and they remain a leader in all of their core markets. Moving on to guidance. Is the pain going to continue, or is there reason for optimism in the upcoming quarter? Well, management is guiding for about $6 billion in revenue in its fiscal fourth quarter, plus or minus 2%. That is basically flat with where it was this quarter. However, margins are expected to rebound back into the 60th percent, plus or minus 50 basis points. So this is the revenue guidance range. The midpoint of that is about $6 billion. That is below Wall Street's estimate, which was itself bracing for a 20% revenue decline year over year, likely to be the reason for the weakness in the share price today. Management does not give earnings guidance, but Wall Street is bracing itself for another big hit with a roughly 50% drop, 40% drop in earnings per share year over year to about 76 cents. Now, for the full year, Wall Street is currently estimating revenue to be about flat year over year and earnings to decline by about 30% year over year. What should investors watch moving forward? First, watch revenue. The inventory situation has been holding back revenue. We want to see that number eventually rebound. Two, keep an eye on the data center business. This is the bright spot and the number one category for the company. Data center is a key area for investors to watch. Three, keep an eye on those gross margins. Management promised a rebound back to the 60th percent in the upcoming quarter. We want to see that happen. And then four, watch the capital return. Management is aggressively trying to return capital to shareholders right now, buy back their stock. That is weakening their balance sheet. I want to see if they continue to do that or if they pull back on there to husband cash and to really keep their balance sheet in tip-top shape. Overall, my impression is that the moat here is stable, and while they continue to roll out new products and make progress on that front, I think that there's an argument to be made the moat here is stable. And the thesis, I would hesitantly say, on track. Perhaps there's some yellow flag warning signs in there, given the inventory issues and given the tensions between the U.S. and China. Perhaps you could make this a yellow flag. I would leave that to you to say. But if your thesis for this company is continued domination in the key markets that it operates, it is making progress, and I think its moat is stable there. So largely the thesis is on track, but this is not a slam dunk green on track by any stretch. Thinking through valuation, where is the company on this growth chart? Well, it's clearly in the maturity phase, and this is not a static thing. So the company could be moving more towards the decline, back towards the early end of the phase, and because of that, when we think through the company's income statement, right now, in theory, due to the weakened demand and the inventory challenges, the company is not optimized for much right now. This is in theory. Now, also in theory, by 2024, next fiscal year, all of these numbers should return to normalized state. That is in theory, of course. But either way, when we're thinking through the valuation, we can look at the price to sales, price to gross profit, price to EBIT, price to earnings, and price to free cash flow, and at least draw some conclusions from there. Not perfect conclusions, but some conclusions for you. But first, I think it's helpful to zoom out and just look at NVIDIA's revenue, essentially since it came public. Look at this period right here. Obviously, a massive increase over the last 3 years, just huge growth in this number. And a question that investors have to ask for themselves is this sustainable? Was this a one-time thing, given the favorable backdrop? Is this number sustainable? Is the big question that investors have to ask themselves right now. Right now, it's likely we're going through a down period in revenue, which the company has gone through before. That's a question that I don't have a full answer to, but I will show you what Wall Street is expecting on there. Now, why are margins so important here? Well, look at the company's margins during during these extremely good times. Gross margin's been very high. Operating and profit margin have also been very high. But if you look back to previous downturns, margins really took a hit. So the question that I don't know the answer to is, are these more likely to be normalized margins, or are these margins that we've seen more recently sustainable? Is a high gross margin sustainable? Is high profit margin sustainable? Those questions really matter when you're thinking through how to value this company. I don't have a good answer there, but I'm not 100% convinced that these margins are sustainable. I'm guessing they're going to be higher than normal, than they have been over the past since the company was founded, but I don't know if these are sustainable. That's going to be a question that we only see as the company continues to report. Another thing to keep in mind is that the industry that this company operates in, semiconductor, is cyclical. Here's Intel's revenue, right? There are periods when declines do happen. The overall trend is up and to the right, but this is a cyclical industry. Their downturns in revenue are normal. Here's Texas Instruments, same thing, right? You see the cyclicality of the company's revenue. It does move up and down over time. So just keep that in mind as you're thinking about this company from an investor lens. Now let's look at the company's, a couple of the valuation metrics that are available today. So here's the price. So you can see that NVIDIA stock reached a peak of 300 about a year ago, currently about 159, so down about 50-ish, 40-ish% from its 52-week high. Let's look at the price to sales ratio. It was almost 35 at the peak, currently 13. So down substantially year over year, but 13 is still a very high number in absolute terms. How about from a gross profit perspective? NVIDIA has gross profit of about 18 billion trailing. Divide that by the company's market cap of 400 billion. You're looking at a company trading about 23 times gross profit. Again, a very high number. How about PE? PE, in theory, is not fully optimized right now, although it could be if those margins, if the weakened margins are here to stay, trading at 52 times trailing earnings. And that is because the earnings estimates have come down a lot. You can see that at the peak, it was trading at about 97 times trailing earnings. So still a very elevated number compared to the rest of the market. Price to free cash flow, about 64 times trailing, and price to earnings on a forward basis, so using next year's earnings estimate as the denominators, 47. So when you compare these two numbers together, on a PE basis, PE says this company is still expensive despite being down substantially. Now, that number still implies that Wall Street is expecting big-time growth here. So let's take a look at the estimates for right now. So here's the revenue estimate for 2023, $27 billion roughly. For next year, 2024, revenue is estimated to grow to about $30 billion currently, and 2025 growing to $36 billion. Currently. So Wall Street is still bracing for about 20% growth in the top line over the next 2 years. However, if you look back at the purple line here, this is the revenue estimates for the year. You can see that previously it was $35 billion, and that has been reduced all the way to $27 billion. But given the valuation today, it is very clear that Wall Street is still expecting 2023 to be essentially a flat year from a revenue perspective and a sharp rebound in 2024 and 2025. Now, this is not a stock that I have ever owned, but I think it's one that is worth studying because it has become so important to being a bellwether for all things tech related. And because this company sells products into many markets, it is definitely worth watching. This is not a stock that I personally own, and given the numbers, I understand why people do. And there are reasons for continued optimism from here, especially looking at those Wall Street's estimates, but I don't know how much faith I would place in those myself. So this is not a stock that I'm interested in owning, and I would have to see it get significantly cheaper before I'd be interested myself. But either way, I'm going to continue to watch it and track this company's progress because it is a very important business in today's modern economy. Hope that you found this review to be useful. If so, please give this video the thumbs up and let us know what stocks you're interested in us covering their earnings on. See you in 90 days on this one. Brian, out.